Yesterday, sort of lackluster, flat session. Same can be said of last week. Do we need some very strong earnings beats to get momentum to the upside again for equities?
Well, that would certainly be helpful. I mean, we had a great run already this year, but that basically puts us back to pretty close to the highs. But I think if we're going to drive the market higher from here, we're going to need to see decent earnings news, but also a good GDP report on Friday would be helpful, and stronger economic data, which we're starting to see out of China and elsewhere. The sense that maybe the global economy has bottomed and we're starting to see a little bit acceleration would be very helpful.
How do you frame earnings so far, Simeon?
So far they're not great. We've got about a fifth of the S&P 500 reporting 2 or 3% top-line growth, which is not bad at all, but basically flat on the earnings front. And that is the concern over perhaps we were at peak margins, especially as we're trying to anniversary those big corporate tax cuts.
You're positioning yourself into some mid-caps in the U.S., is that right?
I think that's a good place to be. If you look at the earnings season so far, mid-cap earnings are coming in a bit stronger, but also interestingly, the margins already declined in mid-caps in Q4, and we know that mid-caps underperformed for the past 5 quarters in a row. So maybe some of the pain there has already happened in front of that in the S&P 500.
Ed, you're a little more constructive, adding some risk into U.S. equity portfolio.
That's right. I started the year maybe a little too conservative, right around benchmark weights, and we've been adding to our equity exposure around the world, especially in the U.S. and emerging markets. But now we're starting to have an internal debate about whether we've been a little bit too pessimistic about IFA, which has lagged a bit in the last several months. But valuations there look quite attractive, and they'll be a derivative beneficiary if you do see faster growth in the U.S. and China. IFA, Europe, Asia, and Far East.
Well, which parts of that? Because there's a lot of different sort of strategies at play there. Europe and China are very different places to be, for example.
That's right. Well, Japan looks very cheap. I mean, they're selling at 12 times earnings at a country with 0 interest rates. In Europe, similarly, valuations are quite attractive relative to other places. Of course, all kinds of geopolitical risks.
I was going to say there's a reason for that.
but if China does start to grow a little faster, it may be that the biggest benefits from a stock market perspective are not in China, but outside of China. I mean, China's already seen a 30%
I get that
run.
for Far East, but what about for Europe?
Well, Europe, Germany is a huge exporter, and a lot of their economic troubles have been because of weak exports to China. Their auto sector and others has been a little bit weaker than you would expect for idiosyncratic reasons.
Problems with the United States too.
So yes, that's right. So if you see a pickup in the global economy, and you can get, say, a high-quality company for 12 times earnings here, and just as high quality but 17 times earnings here, from an investment point of view, you might actually do better buying the cheaper company. We're not quite there yet, but we're giving that serious thought.
Simeon, overseas for you, where do you like?
I think the dark horse right now is the UK. I mean, remember, there's 17–18% energy in the FTSE 100. That's more than triple that in the S&P 500. So, and of course, prices are beaten way down from all the Brexit concerns. So there's a real opportunity there.
Do you think energy stocks can catch up with the oil price gains? Because they have lagged kind of broadly wherever you look.
I think they can. I think the piece that might lag is the service component. We've seen weak results from, say, Schlumberger in earnings season so far. So it's not clear that the drillers and the service guys can catch up, but the broader folks can catch up with energy prices.
The last weekly report, though, in the United States showed that the number of wells was actually down. I think
that's right.
Down
that's
by 2
right.
or
So
because
I
people
think
still aren't ready to kind of buy into
that. May be the lagging piece, but the broader energy folks could catch up to energy prices, and that's what's a lot in the FTSE 100.
Are you avoiding fixed income or adding now?
We've been pulling back a little bit. We have a bit of a barbell approach in our multi-asset portfolio. So I still own a big chunk of Treasury bonds to kind of offset the risks in some of the equity portions of my portfolio. But we've been trimming that a little bit, taking duration down a little bit, but also within fixed income, adding a little bit to risk. So we've added a little bit to high-yield bonds, for example, and cut a little bit our position in Treasuries.
Simeon, in fixed income?
Yeah, if you look at high yield and investment grade, the interesting issue right now is the yield curve is very interesting in the corporate space. You're only getting spread if you take full duration. But that, of course, is a challenge with interest rates so low. So one opportunity is to take those full duration high yield bonds that have 2%, 200 basis points higher spread than on the short end, but you can hedge out the interest rate risk. The hedge is almost free because the yield curve is flat. So I think that's a very interesting opportunity in the fixed income market.